Hello and welcome back. My name is Josh Lipton. This is Finance Soup. And today I wanted to go over something I thought was a little interesting that I recently saw. So I was on Instagram, which I rarely do, but I saw an ad to raise money in a business called Miso Robotics. Here's the thing, Flippy. I'm just going to play the video here. You can see it's like a robotic arm.
For the employee when they're not having to stand behind a fryer or stand on top of a grill.
That helps in the kitchen. Now, I've recently been looking into some robotics companies that I think are really interesting because I do see wages in North America going up, which will only put more pressure to automate low wage jobs like cooking, cleaning, baristas, all that. So I think this is going to be a growing space. Um, so I clicked on the ad just to learn more, and I decided it'd be a nice little way. Again, this whole thing is for me to document my journey. Sometimes I'll invest, sometimes not, but it's really just a learning opportunity. So I went on and I hit the sign up. It sent me a thing that said, "Oh, we're looking to raise $30 million." Seemed interesting. Um, but here's what I wanted to say. Um, if you go back, I posted a video that talked about my biggest mistakes, and I wanted to bring that up again because this is a case where even if you really believe in the industry or the company, first of all, this is like angel investing. There's no profits, there's no revenues right now. They do have some interesting partnerships. You can see investors and customers. And, it said, oh, they recently launched with White Castle a pilot program. Could this be huge? Yeah. And I do think this is going to be a growing industry, but there's been other companies in this field that have failed before. Um, but when I posted my biggest losers, the number one thing was, or one of the sections, it was, taking tips from someone else. I would say like, I'd never heard of this company, so I took a tip from Instagram. So I said always do your own due diligence, so I did. But the other one was financial complexity, and that's where this kind of runs into trouble. So, because you're investing in a very illiquid uh, security, you're investing in this company before it's publicly traded. There's a ton of disclosure. You can see here there's 25 pages of documents just outlining, you know, you got to sign this stuff saying, I understand the risk, blah, 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 blah. And then on top of that, there's another thing that they have with the SEC going over how much they're raising. These are preferred shares, how many shares at D, how many shares at C, what's the cost basis, all that. Again, this is not for your average investor. I'm doing this so you don't have to. And I read it over and I wanted to go back to, I posted videos saying which channels I review. And, this is not about valuation, but there is a channel, Everything Money. Again, I think they're way too conservative with their estimates, but one thing they really taught me was the valuation or how dilution, share dilution, can kill your investment. And it can be a great business, but it can be a terrible investment if there's enough dilution. And that stood out to me when I looked at this. So again, there's different, there was common shares which were raised, again, it says in 2016 to 2019, then there were Series A, Series B, Series C, and now they're raising a new one, Series D. I think it said that somewhere here. This new 30 million round is a Series D. You know what I think it says at the top here? No, maybe it's here. Here we go. Preferred Series D. So that's the newest round they're raising. They're trying to raise more money. Makes sense. But there were two immediate red flags. So one was a lot of people say it's never been easy to raise money. I listen to a lot of podcasts of startups, and it seems like everyone's getting money left, right, and center. So I thought it was interesting that instead of going to VC, they're trying to raise money publicly and paying for ads on Instagram. Okay, not necessarily a good sign in my case because to me, if I always try to say, am I getting fucked in this deal? And if I were a swindler, I don't think I could get past a VC, but I might be able to convince some people on Instagram to invest with me by showing some flashy videos. So again, not saying they are. I'm saying red flag number one, that they're trying to raise money publicly in today's environment. Again, I think at times it makes sense, but right now I think it doesn't make sense because if they really want to raise money, they could go to anyone. I think they'd be able to raise money. So maybe it's because it's beneficial, but again, I'm trying to look at it from my perspective, and I'm going to get a good valuation. So Then they talk about, how much are they going to raise, and based on how much they raise, how much they're going to get diluted. So we see here, how much they're raised. So they said, oh, it could be 30, 31, 45, or $60 million raised. And based on that, here's how much capital is coming in. Again, at 30 million, they're raising 30 million. What's their net tangible book value? So that's how much the company is, the book value, how much money the company has in their coffers and their worth post financing. So 33. How many post finance shares would be outstanding? So again, this is how many shares are currently there, and assuming full conversion. So if everyone converts their stock options plus the new shares, how many shares? And then when you look at it, net tangible book value per share is $4.37. So it's the dilution per share, $12. Again, your price per share is 17, and you're diluting it by 74%. It's even worse if you raise more money. This is massive dilution. This is insane, and this is to new investors. If you've ever seen, if you're wondering what share dilution, what does it mean? So again, a company is divided into shares. Let's say there's 10 shares, then you own one share. That means you own 1/10 of the company. When you bring on new investors, someone says, I want to buy 50% of the company. You don't sell 50%. Everyone who is in that 100% then becomes 50%. So they get diluted by 50%, and the new shareholders now own 50% of the company. So it dilutes existing shareholders. And if you've ever seen the great movie by Fincher, The Social Network, about Facebook, there's a great scene. Actually, let's see if we can find it. It's Fincher, Social Network, Dilution. I think this will play. Always that. Always. Ever great. I don't even know why.
Email from Mark telling me to come out for the millionth member party.
What else did the email say?
It said that we had to have a business meeting. It wasn't.
What was Sean Parker?
Here we go.
How much for his?
What?
Mark!
He's wired in.
Sorry?
He's wired in.
Is he?
Yes.
I found out you're still wired in?
Security.
You issued 24 million new shares of stock.
You were told that if new investors
How
came
much
along...
were your shares diluted? How much for his?
What was Mr. Zuckerberg's ownership share diluted down to?
It wasn't.
What was Mr. Moskowitz's ownership share diluted down to?
It wasn't.
What was Sean Parker's ownership share diluted down to?
It wasn't.
What was Peter Thiel's ownership share diluted down to?
It wasn't.
And what was your ownership share diluted down to?
0.03%.
That gives a good idea, but basically, they diluted him so that he owned, instead of like 30% of the company, basically nothing. So a dilution is a silent killer. It can really destroy your returns. So that was just something I found interesting. And I'll also show here, they're asking for $67.94 per share through this site. So again, found that interesting. It was an interesting experience learning about this company. I wish them the best, but I personally am going to pass on this investment. Just too complicated, too many risks. I don't want to read this whole thing. Maybe I'm missing something here, but it seems like there's going to be a ton of dilution. And what's to stop the next person from coming in, from diluting you even more if they want to raise more money? I'd rather come in when they have product market fit, and this seems to be a growing business. Like, yeah, I won't hit 1,000xer, which you can only do if you're investing in really early stage startups. But I'd rather get like a 3 to 5xer and come in when a company actually is early. I'd rather be early than super early, because super early you're going to get a lot of misses. I'd rather have a higher success rate, but not hit those 100 baggers, and instead just hit a Tesla. It was public, and when I saw that they were getting product market fit, I invested. So that's the way I invest. Again, my name's Josh. Hopefully this was informative. If you have any other interesting investments you'd love me to review and look at, just let me know in the comment section below. Thanks again. This is Finance Soup, and talk to you next time. Cheers.